Well, good morning, everyone, and welcome to Energy Action's gas webinar. While we wait a few minutes for others to join the webinar, I'd like to introduce myself. My name's Scott Easton, and I head up the trading and pricing team here at Energy Action, and my colleague, Julie Doe, who is our senior trading and pricing analyst here at Energy Action.
Good morning, everyone, and welcome to the gas webinar.
Julie and I have over 35 years combined experience in energy markets and have conducted over 1,000 energy procurement events, managed a portfolio of progressive purchase customers in excess of 1 terawatt hour per annum, and provided consulting services to some of Australia's largest energy users.
So later in the presentation, we will be drawing on our experience to provide some insights and tips on what you should consider when going to market to renew or extend your existing gas supply agreement.
Thanks, Julie. That's right. And today we'll be discussing why your savings don't stop at electricity and how to maximise the savings in the current gas market environment. The agenda for today is that we will present how to take advantage of current market conditions, how similarities with electricity in the electricity market price cycle now presents opportunities to save on procurement costs in the gas market, and some of the things to consider, such as managing take or pay obligations and how to manage variable price risk if you're considering a wholesale supply arrangement.
Okay, so gas prices currently offer customers the same opportunities to save as we've seen in the electricity market. So gas prices at the moment are at a 5-year low.
Yeah, that's right, Julie. We've seen that gas, of course, as is electricity, is a commodity, and we've seen this boom to bust cycle where we saw a large number of new entrants back in 2019 enter the market with additional supply in order to, take advantage of the high retail prices that were in the market at that time. This supply has now come to market, and we seem to have reached that boom and past that, and are now, when we look at some of our graphs, we'll see that we're now in the bust cycle. This cycle tends to last between 5 to 7 years, and when we take a look at those charts, we'll see just this process of boom to bust.
So the fundamental factors that drove prices down from late 2019 are likely to also continue into the medium term.
Yeah, that's right. The number of new suppliers entering the market, gas being diverted away from LNG or export markets to supply the domestic market. And that fragmentation, an increase in the number of smaller players entering the market has created more diversity and less concentration for gas supply. And similarly, gas policy, as we've all seen in the news headlines recently, is emerging. We're seeing gas as a potential lead for recovery from COVID. Through the stimulus that it provides in terms of manufacturing output. And we're also seeing some of the domestic market suppliers who, as a condition of their license agreement, have to supply locally, which is also increasing the domestic supply of gas.
Okay, so looking at this graph here, we're able to see spot prices has dropped by approximately 50% since April 2019. A factor of that is a large volume of new supply has come to market. LNG netback prices have also dropped by 60%. New producers are competing to sell new sources of gas supply. The government is also encouraging large LNG suppliers to sell locally, and the price drop is based on supply and demand and appears to be a longer term trend.
Yeah, we can see from that chart that there is a significant downturn in price from September 2019, and around March 20, we've since seen a sideways trading pattern. If we move to the next slide, we can see that in fact, that is very similar in terms of what we've seen in electricity and what we're seeing for the 2021 contract market and in fact 2022 contract market, which is a significant drop followed by a sideways trading pattern, suggesting that we've reached the bottom of that boom to bust cycle I was referring to earlier on. So we are currently looking at 5-year low prices across both electricity and gas. But for gas, we can see from this chart some of the price trends. So the 12-month rolling average of gas prices, let's take an example. Look at Melbourne at $5.27 compared to the year-to-date 2020 average gas price of $4.07. So what that indicates is that the more recent supply or more recent pricing is lower, or that we are in a downtrend, and significantly we can see that from the charts we've looked at. But just in terms of pricing, a drop from $5.27 in the Vic Hub to $4.07, and then we're seeing for our current month average $4.32, which is above the $4.07 year-to-date average. So we're just seeing a slight uptrend in the most recent month, which indicates that prices have trended down, stabilised, and we're now just seeing some natural volatility in the market from month to month. And that chart, you can see in terms of annual gas prices, 2019 prices up around $9 a gigajoule, compared to the year-to-date 2020 average, where prices are around $5 a gigajoule.
Thanks, Scott. So at the moment, we're currently seeing savings or large savings for future rates compared to what you currently contracted on. So we're currently recommending for you to contract 2021 as well as 2022. Wholesale gas procurement is also a viable alternative to fixed price. Earlier this year, we also saw a large price spread between wholesale and retailer, which has now narrowed. Energy market policy is also promoting low price gas, so we're recommending to stay short. And we've also seen that blend and extend products are not favourable for customers looking for cost relief to 2023.
Yeah, that's right. We're seeing a step up again in gas prices in 2023, back to approximately around the $10 gigajoule. So customers looking to blend and extend, including a 2023 contract year, are finding that there's limited benefit. So our view is that with 2021 and 2022 prices in the retail market between $6 and $7 a gigajoule, that now is the time to be contracting your forward energy supply. Okay, in terms of gas markets, we've talked about the oversupply, the decline in export demand, and the new sources of gas production. We can see that in dollar terms, we're seeing similar savings for gas as we saw for electricity. So many of our customers have saved significantly based on the decline we saw with electricity. And what we're saying is that we now see those same or similar opportunities for saving in gas. So we're seeing a retail price down from $10 a gigajoule, and in some cases higher than $10 a gigajoule in late 2019, to where they are now today, around $6 to $7 a gigajoule. The wholesale price, of course, which drives the retail market, is down from $9 to $5 on a year-to-date average.
Yeah, Snowy 2.0, it's commencing in 2025. It's also possible that hydro will replace gas as the primary firming fuel. So that just means that there will be more gas available to the industry in the future.
Yeah, that's right, Julie. It does affect future supply. So while we're seeing 21 and 22 now very favourable and 23 not so favourable, we can see that fundamental changes looking forward in the market will continue to support our view of oversupply.
Yeah. So at this stage, we are advising to defer contracting 2023. As Scott mentioned, forward prices are increasing to approximately $10 per gigajoule for that year, and the low traded volume and price transparency for 2023 as well. That's another factor.
Yeah, so prices for 23 gas, we think will potentially trade lower based on our outlook of oversupply, reduction in the export market, as retailers commence to forward build their sales order book, and we'd expect that to commence around mid to late 2021. So at this stage, we're suggesting that it may be appropriate to defer 2023 gas contracting.
Okay. Yep. So things to consider when contracting gas. So at the moment, retailer gas has a take or pay penalties. So that usually means that when you do sign a contract with a retailer, there's usually an 80% take or pay. So that just means that you're required to use 80%. If not, you have to pay 80%. So for example, if you're only using 70%, you still have to pay the additional 10%, even though you haven't used it. So at the moment, retailer contracts offer price certainty, but usually requires a premium. So we strongly suggest clients to know their usage and get advice on your MDQ, which is your maximum daily quantity, as well as your ACQ, which is your annual contract quantity, to avoid penalties. It's very important to get these figures right when entering into a contract. And this is something that Energy Action does offer. So feel free to give us to contact us for some advice regarding setting your MDQ and ACQ. As mentioned, retail prices for 2021 and 2022 have followed the wholesale market, and which is narrowed between the two, as mentioned earlier. So we're seeing prices down from $10 a gigajoule to approximately $67 at the moment. So we've also seen savings in some cases of over 30% to your compared to the current contracted rates.
Yeah, that's right. It is just the right opportunity to look to forward contracting. Our view is that now is the right time to act, use a competitive market environment or RFP process to secure the best pricing. What we would caution the audience against is accepting offers direct from a retailer. We've found in our experience that direct offers, of course, don't have that competitive tension from a number of suppliers, and therefore it's wise to test the market. And by going to market, you are creating that competitive tension. We'd also caution direct offers, as well as being concerned about retailers approaching you with offers to wipe or to write off take or pay penalties. In the past, we've seen that some of the prices offered into the future can be significantly out of market. And we've got many examples of dealing with customers where we're advising them around these concerns, particularly during COVID, where we're seeing usage levels drop as compared to normal years. So 2023 retail prices, unfortunately at the moment on the forward curve, are returning to around a retail price of $10 a gigajoule. And we're saying that it would make sense to wait to contract 2023 gas, but to immediately explore contracting 2021 and 2022. In terms of the wholesale market, we've seen the forward price. Many customers are now considering a wholesale supply agreement, primarily because it doesn't have a take or pay requirement. So you pay for the gas you consume. There are arrangements in place now through providers where you don't need to nominate your daily gas usage, so there are no forward nominations. And there are a number of providers now offering simplified billing. As you know, it can be quite complex looking at daily rates and daily usage to calculate the billing. And of course, we know there are multiple prices throughout the day at each hub, and many retailers are now offering a very simplified approach to billing. However, you need to be mindful that wholesale offers are a variable price contract, so they do have variable price risk, and that can be managed through notice and converting from a wholesale to retail contract when the market indicates that that's right to do so. So there are a number of ways to manage priced risk. Because we recognise, as we discussed with this boom to bust cycle of commodity markets, that at some point in time that the price cycle will swing back, and knowing when to switch from a wholesale to retail gas contract is critical in terms of ensuring that you can make the maximum savings available through a wholesale arrangement and then convert to a retail fixed rate arrangement to protect those savings. So taking advantage of the wholesale market while they are low makes good sense, and it's opportune to do so right now, and that it's specifically suited to customers greater than 100 terajoules, ideally because the larger loads create both competition amongst retailers and of course the economies of scale through larger load attracting price discounts. So in summary, the gas market, we've seen a significant reduction in both the wholesale and retail rates. We're encouraging our customers to take advantage of this while rates are low by forward contracting now, that there are a number of options not available in the past. One such is access to wholesale gas markets. And we've seen from some of the charts earlier on that there are significant savings to be made with gas prices now trading at around $5 a gigajoule, depending on the hub, and that we're recommending that our customers take advantage of this. Some of the factors behind why gas prices are as low as they are. We can see that, as mentioned, the industry is fragmented, so there are a larger number of suppliers. We've seen new entrants and expansion of existing capacity with the likes of companies such as Beach, Armour, Cenex, Cooper and Westside, which have all entered the market. We've also seen recent fast tracking of projects in the Northern Territory, in New South Wales, and certainly Victoria. And so we can see the government's support for both fast tracking and in many cases, as mentioned before, a condition of that gas licence is to provide domestic supply. So it stops those producers from exporting. We've also seen, of course, a decline in the LNG or export price. And we did see some gas contracts, export contracts, which were lost to our international competitors. So we know that until these contracts are renewed, that prices which were being driven by the export market, that gas is now going to be supplied domestically. So a number of these new entrants that we just discussed initially joined the market to backfill export gas. And of course, as we know, there have been lots of changes, the drop in export demand and the coincidental increase in domestic supply, that we're currently now oversupplied. As Julie mentioned with regard to Snowy 2.0, coming even closer to present, we're seeing that gas-fired generation is also declining. And that's primarily as a result of the amount of renewables in the electricity market that's being commissioned, and we're seeing that renewables in many cases are displacing gas-fired generation during the day, and that this trend, according to AEMO forecasts, is likely to continue. In summary, our outlook for the gas market is that Australian gas is a relatively immature market, and it does lack price transparency. That is, that there are low forward traded volumes, and it's very difficult to gain timely pricing unless going through a procurement event in the retail market. So as a result of this illiquid forward market, futures, and the difficulty in terms of price discovery, that we're seeing forward pricing primarily based on those fundamental factors of supply and demand, and that in our view, according to the new entrants that we've seen into the market, that we see an oversupply, and that is to remain, according both to AEMO and our calculations, certainly in the short to medium term, where we see this oversupply continuing. So really, in summary, we've seen certainly a reset in both the cost of gas, and it's been a very similar trend as we saw with electricity, where prices declined significantly, and we're now seeing them trade at or very near the cost of production. So we see this significant drop and then sideways trading pattern, which appears to be setting a price floor. We know when we were discussing and looking at electricity in the past, many customers were saying, well, why shouldn't I wait and see if the price drops further? And of course, we've seen that prices have begun to trend upwards in electricity. So the ideal time for electricity contracting is now in the past, and that's because prices just aren't able to drop below the cost of electricity production. Now, that similar observation we're able to make for gas. So we see that significant downtrend, sideways trading pattern setting a floor, which we believe is at or very near the cost of production. So we really can't see any further significant declines in the wholesale gas price, and that's why our recommendation is to act now and save your organisation in gas procurement costs. Okay, we will now turn to any audience questions. Please feel free to send through if you have any questions, and we will attempt to address those.
Yeah, so first question we've got is from Todd. Why did the Brisbane gas price increase recently whilst Sydney, Melbourne still dropped?
Yeah, that's a good question, Todd. We're actually, that was a couple of weeks back. What we saw was a compression station in outage. So there was a failure in terms of that compressor, and it actually spiked the price for one day where prices did increase. We generally see a trend around gas pricing that is, in terms of prices, very dissimilar to electricity in terms of the volatility in price. So the electricity market, we see, prices are capped at $15,000 a megawatt hour, and last week we saw prices jump to $7,500 a megawatt hour. In contrast, the gas market has very low volatility, and its extremes, or the high prices, the extreme price that we've seen for gas since 2008 was in fact $14 a gigajoule. So you can see the difference in volatility and the implications that has for managing gas supply. So that would certainly be a consideration when looking at wholesale. But as the question here is looking at the difference in supply conditions in each of the state markets, so the Adelaide, Sydney, the Victorian and Brisbane hub prices. And we do see some volatility, generally around a short-term supply and demand disruptions, with the primary average price being driven by those fundamental supply and demand factors that we discussed earlier.
Okay, got a question from Tim. If accepting an offer direct from a retailer, are they reviewing ACQ and MDQs, or this is up to the customer to determine? So in the past, customers who have provided us their contract, the direct offer from the retailers, we usually see it's either identical to what it was the same time, I guess last year that they've contracted to. And sometimes even with the MDQ, the retailers may just pick the highest MDQ that they've consumed over the last 12 months instead of reviewing the data and maybe choosing the 9th highest to produce a more favorable MDQ. So a little bit of overrun outweighs, I guess, the potential lower rate that you can get.
That's great observation, Julie, and a good question, because it is it's an expertise in determining the ideal point to set your both your annual contract quantity for take or pay reasons, but your maximum daily quantity. And as Julie was saying, it's a trade-off between setting it high enough so that you're not paying penalty charges, but setting it low enough so that you're not reserving capacity in the pipeline that you're not using. And so we've developed that technique. We've certainly advised many of our customers on how to optimize that trade-off in setting the ideal maximum daily quantity in order to reduce your overall costs.
Okay, thanks, Scott. So Jason's question was linked to easing, his previous question regarding the Brisbane gas prices. Is it linked to easing of COVID restrictions? Would we expect the price rebound as business activity increases in future?
Yeah, another good question. And if we just jump back to, or if we look at some of the charts that we presented earlier, we can actually see that prices were trending down before COVID. So we saw that certainly for, in fact, both gas and electricity, we saw this downward trend commence in about November 19 before COVID. And in fact, for the gas market, the downtrend had actually stabilized by March, April, when COVID, I guess had fully been identified and the impact and certainly the first wave of COVID was known. And we've seen prices trade sideways since then. So it's really not a direct, whilst it's been impacted by COVID, it's not a direct effect from it. And so we're not forecasting that gas prices will swing upwards as demand picks up for gas, primarily because it's around those fundamental supply and demand factors. And it's a good question because we did see that, or we are seeing that for electricity. So in fact, in electricity markets, we're seeing that the pickup in demand, primarily in Victoria, where we've seen demand hardest hit and prices decline the most by state market, that in fact as we emerge from COVID, we are in fact expecting that increase in demand to push prices higher. However, that's not the case in the gas market because it's being driven by other factors, primarily those longer term fundamentals that Julie mentioned. But a great question. Okay, we're at time. So I'd just like to thank everyone for joining us. My hope is that it's been useful and that if you are considering forward contracting, which we would encourage you to consider, either electricity, if you haven't already, or certainly in terms of making savings for gas, that you would reach out to us both in terms of our ability to be able to provide you with advice, setting your maximum daily contract and annual quantities, and of course, guiding you through the process of procurement by creating that competitive pressure within the market in order to secure similar savings for your gas procurement as we have for your electricity. So thanks very much, everyone.
Thank you. Hope you have a great day.
Have a great day. Bye-bye.